In this mini lecture, we'll be looking at Chapter 16 on control. Listed on the screen are the learning outcomes. You may choose to review them now if you like by pausing play. All right, control is really just evaluation. And so when we talk about control in management, we're establishing standards to measure whether we've achieved our goals. We're comparing our actual performance against those standards, and we're taking corrective action, and sometimes we're actually taking preventative measures as well. So I feel like when we say control, people are like, what are we talking about? But really, if you think about evaluation and corrective action and preventative action, that really does a good job in describing it. Your book talks about a cybernetic control process. Basically, it's just this idea that you're setting your standards and you're measuring them, identifying where you have issues, what those issues are, and correcting them. One thing I do really want you to pay attention to is this concept of benchmarking. And benchmarking is just identifying best practices, best processes or standards in other companies, and then adapting them to your company or comparing yourself against those standards. All right, so feedback control mechanisms are really just different ways that we can gain feedback. Feedback control is a way to gather information about performance deficiencies after they occur. So feedback control is something happens, there's a problem, and we fix it after the fact. Concurrent control is we're gathering information about deficiencies in real time, thereby eliminating or shortening the feedback. So as it's happening, we're finding these issues and fixing them. And then feed-forward control, we're actually trying to prevent or minimize performance deficiencies before they occur. A balanced scorecard is one way that we can measure, and it's really popular in management. So it separates an organization's performance into 4 areas of finance, customers, internal operations, and innovation and learning. And so what it does is it allows managers to set goals in those areas and then to evaluate them in those areas. And it's usually done in like one sheet so you can kind of see what's happening. And I'll give you an example here. So here's a balanced scorecard. You can see there's the financial goals. Here's the target. Here's the actual. And you can see whether it's on target or not. Customer goals, learning and growth, internal business processes. So a lot of companies use something like this to really easily see what their goals are and see whether they're meeting them or not. It's also important to control our finances, and we do this through cash flow analysis, balance sheets, income statements, financial ratios, budgets, and by computing our economic value added. An income statement summarizes either a fiscal year or a quarter or a specific amount of time and looks at revenues and expenses. And so you can see here that this is for a 5-month period. We have our revenues, we're $108,000. We have our expenses and losses, we're $90,000. So the final net income for this sample company was $18,000. A cash flow statement allows us to see how much cash we have on hand at any time of the year. And so any cash coming in is in the black here, and any cash going out is in the red. So you can see that we had $15,700 in cash at the beginning of the year, and at the end of the year, we had $35,200. So in 2014, our cash flows were $19,500. So we brought in $19,500. We add that to that $15,700, and you get that $35,200. So this one looks at it from a year, but many organizations actually look at it on a monthly basis. So here you can see this company had no cash sales to start with. All right, so there was a new company. They got some investments, loans, etc. Had some money going out. So their initial cash balance when they started was $41,400, right? So you look at January, and they didn't have much in money coming in, but they had a lot of money going out, so their cash flows were actually negative. So after January, their cash flows were $31,012. And so you can see here they had negative cash flows, which is normal for a company that's just starting. But it allows you to see how much money and to project how much money is going to be coming in and going out each month or quarter or whatever you're looking at. A balance sheet shows us our assets, liabilities, and owner's equity. So our assets are what we own, our liabilities are what we owe, and our owner's equity shows us how much money we'd have left if we sold our assets and paid off our debt. And so you can see here that all our assets are $770,000, our liabilities are $481,000, and our stockholders' equity is $289,000. And our assets have to equal our liabilities plus our owner's equity. I'm sure you remember that from your accounting classes. So we have some different tools we can use to control for finances. These include budgets, which really just helps us to determine how much money we're going to spend or we're going to allocate to help us achieve our goals. And zero-based budgeting is a technique where managers justify every expenditure every year. And so we can use these tools to assess our financial performance. And honestly, there's a lot of software packages that do a lot of this work for us. Economic value added is the amount by which company profits, so revenues minus expenses minus taxes, exceed the cost of capital. And so I don't think this is a really intuitive concept. So I found this great quote from a former CEO of Coca-Cola who said, "You borrow money at a certain rate and you invest it at a higher rate and you pocket the difference." And so economic value added is used to really measure what value a company generates from funds invested, that it has invested. However, one of the issues is that EVA relies heavily on invested capital and is better for asset-rich companies, where companies with less tangible assets or intangible assets, such as technology businesses, might not be good candidates. And so here's an example. So this company had a net operating profit after tax of $3.5 million. All right. They invested they borrowed $16.8 million. The cost of capital, this is pretty high here, 10%, but right now interest rates are high, so it would be. You multiply the capital used times the cost of capital here, so $1.68 million. So it cost us $1.68 million to borrow this money. And then we take our NOPAT minus our total cost of capital, and we get our economic value added. So we borrowed $16.8 million. It cost us $1.68 million to borrow that, but it allowed us to make an extra $1.82 million. And that's what economic value added is. All right, and so then the other thing we need to look at is controlling for customer defections or customers that leave. And so we do this by identifying which customers might leave, why they're leaving, and what rate they're leaving. And customer retention is really important because it is really expensive to get new customers. 70% of companies say it's cheaper to retain a customer than acquire one. It's 5 times more expensive to acquire a new customer than to retain one. And you'll see a 125% increase in profits from a 5% increase in retention. So keeping our customers is really important. We also want to control for quality. It's usually measured and defined in 3 ways. One is excellence, so having really high quality products or services that others can't match. It's value, so having a good quality for the price. And then conformance to specifications, where employees have to make these decisions and actions on whether services and products are measuring up to our customer standards or to our standards even. And so that's chapter 16, really short, just to give you kind of an overview of some of the concepts that go into controlling and management. If you have any questions, please let me know.